From the Penn Institute for Urban Research and the Volcker Alliance, this is Special Briefing. I'm Bill Glasgall, and I'm here with my co-host, Penn IUR co-director Susan Wachter. Hello, Susan.
Good morning, Bill. We have a powerhouse panel ahead of us today, so let's get started.
You heard it from the professor directly, and that is absolutely true. It's been a month. Can you believe it? A month since President Donald Trump was sworn in for his second term, and what an eventful month it's been. We've seen at least 70 executive orders, that's as of yesterday, federal spending freezes, worker firings, entire agencies told to stop work, immigration crackdowns, new import tariffs, and most likely more of the same to come. And as we observed in our pre-inaugural special briefing, this is having a big impact on the U.S. and global economies, and for states and localities that count on $1 trillion a year in federal grants for everything from Medicaid to disaster relief to education, despite mounting federal deficits and debt. So in the next hour, our special briefing experts will dig into what all this means to the nation and to you. For the big picture view on the economy and interest rates, please welcome two chief economists, Mark Zandi from Moody's Analytics and Torsten Slok from Apollo Global Management. We'll hear next about federal debt and the latest tax proposals from Jeff Holland at the Peter G. Peterson Foundation. And by the way, Jeff has a great slide deck for you to download on the Penn IUR and Volcker Alliance websites. Next, for a look at the states most affected by Trump tariff plans, please welcome Eric Kim from Fitch Ratings. And you'll find a link to his report and some other material on tariffs and the economy on our websites as well. Following Eric, we'll hear how states and cities are faring from former member of Congress Carolyn Bourdeaux. And finally, for the view from the $4 trillion muni bond market comes Vikram Rai. He's Wells Fargo's chief muni strategist. Welcome to you all. Now, we'll get things rolling in just a moment, but first, this word. Special briefings are made possible by funding from the Travelers Institute, the Volcker Alliance, and members of the Penn IUR Advisory Board. We're coming to you live on the Penn IUR and Volcker Alliance websites and also on the Special Briefing podcast. We value your input, of course, and we've taken your questions in advance, and we'll get to them later in the program. So now, let me hand the mic over to Mark Zandi to kick us off. Mark, thank you so much for joining us on a very busy day. What happened to Fed rate cuts? They look to be on hold for now, and the Financial Times asked today, will the bond market rein in Donald Trump? So tell us your story, how the bond market and the economy and all of the Trump executive actions all mesh together into your outlook.
Well, Bill and Susan, thanks for the opportunity to be with you. I don't know how many times I've been on the show with you, but more than once. I assume I've been more right than wrong, and that's why you keep inviting me back.
Definitely.
So thank you. And it's good to be on with a lot of good friends and acquaintances. I see Torsten and the Congresswoman. I have a great story about the Congresswoman, but I won't tell you. Tell you that if you ask. Anyway, my sense is that the economy, it came into 2025 performing exceptionally well. Growth has been strong. GDP last year grew almost 3%. That's a really good year. Lots of jobs. The economy created 2 million jobs. That's a lot of jobs. Unemployment is low, stable at 4%. I think it's been around 4% now for almost 3 years, maybe a little longer, which is, I don't know if that's unprecedented, maybe in the 60s, but we had a period like that, but exceptionally well. Stock market at a record high, housing values keep marching higher. The only blemish has been inflation. It has come in, but it's still above the Fed's target. And at this point, it feels like we're not going to get back to target here anytime soon, particularly with the tariffs starting to kick in and the inflationary effects of immigration policy, I think, going to play a role later in the year. So that goes to your question, Bill, about the Fed. I just don't see the Fed cutting interest rates here until get a better feel about inflation coming back to target. The other factor I think that's playing a role, and you could see this in the minutes to the January meeting. Fed members are concerned about economic policy, the uncertainty of economic policy. Tariffs being front and center, immigration policy, I mentioned that, But there's a lot going on this year, fiscal policy, tax spending policy. We've got the potential for a government shutdown here in the not too distant future. And the Treasury debt limit, of course, needs to be resolved again. By our calculation, the X date when the Treasury runs out of cash, unless something's done legislatively, is late July, early August. So, bottom line, the economies came into 2025 in a pretty good spot. Feels like it's performing well. Should be able to weather a lot of storms, but Bill, it feels like there's a lot of storms coming.
Duly noted, and stick around for the Q&A if you can. And Susan, why don't you
yes, thank you. I'll take it from here.
Torsten.
Thank you, Mark. We'll hear more about the storms coming, and we now turn to Torsten Slok, who is chief economist and partner at Apollo. And we have an incredible record on this program of our macroeconomists, the best in class, being right. And you are right, too, along with Mark. So what's your view on inflation? Is it going to be sticky? And what will happen to rates going forward? And your overall views on the economy, please.
Absolutely. And also thanks for having us today. This is, of course, a very important discussion. And just to add to what my good friend Mark was saying, which I totally agree with, that the economy is pretty strong. One thing that we've been watching more recently is, of course, the impact of DOGE. As we all know, there's a lot of things going on when it comes to layoffs in the federal government. Studies from Brookings show that for every federal employee, there are 2 contractors. So the true federal employment is not the 2.5 million or so that you see in the BLS data, but maybe it is almost as high as 8 to 10 million. So in that sense, the implications of those from a macro perspective could become very, very important for interest rates, especially, of course, if the layoffs begin to show up in the form of a high unemployment rate. This week, we just got literally here a few hours ago at 8:30 every Thursday a.m. in the morning. We get data for how many people filed for unemployment benefits in the last week. And that continued to be relatively low. So up to this point, there is no dramatic increase, at least in the number of people who file for unemployment benefits. But we're watching that aspect of government policy very, very carefully, because if the unemployment rate does begin to move higher, it would certainly have very important implications, not only for Fed policy, but potentially also for long-term interest rates. So taken together, inflation, unfortunately, is a little bit too high. But from a Fed perspective, GDP growth is, in round numbers, it's been around 3 for the last several quarters. The Atlanta Fed at the moment says is 2.3 here in the first quarter, still above the CBO's estimate of long-run growth at 2%. But the issues that are now the crosswinds that are blowing at the moment, some things argue tariffs and restrictions on immigration for more inflation. But in the very near term, we're watching very carefully what the impact is of those, in particular, whether it will have any macroeconomic implications. So if the layoffs are going to be in the 200,000, 300,000, 400,000, it's probably going to not have much impact, given total employment is 160 million. But if the layoffs do come into the 500,000 or up to 1 million or even more, then of course it would be more meaningful and therefore have a risk of having a negative impact on the unemployment rate and therefore on interest rates.
Well, thank you, Torsten. Susan, you want to introduce Jeff or
Yes, absolutely. Yes, thank you very much, Torsten. And we'll hear now from Jeff Holland, who from Peterson Foundation, who will tell us his views on the deficit. Jeff?
Great. Thank you, Susan. Thank you, Bill. Glad to be here with this distinguished panel. As Bill mentioned, we have some slides available on the website if you want to follow along. I'm just going to give you a brief overview of the current fiscal situation and then some of the actions that we expect to see out of the Congress coming up. So, as you all may know, the Peterson Foundation is very concerned about the country's fiscal trajectory. So compared to the size of the economy, our current debt is around 100%. It's about the same size of the economy. And under CBO's baseline projections, which assumes that current laws stay as they are, we would exceed the all-time high of deficit to GDP ratio of 106% of GDP in 2029. CBO has that ratio continuing to grow to 118% 2035 and 166% about 20 years after that. So why does that matter? Well, high debts and high and rising debts crowd out savings and investment, which could lower future output and income relative to what would otherwise occur. The risk of a sharp jump in interest rates, perhaps related to a flight from U.S. Treasuries or U.S. assets more generally, would be heightened. Higher rates of inflation or loss of confidence in the dollar would have a greater chance of occurring. And tax revenues would be used to pay interest rather than to finance our current programs. And speaking of interest, that's perhaps even more of a concern, the ability to service our debt. So net interest payments this year will approach $1 trillion, or again, measured against the size of the economy, about 3.2% of GDP. That's pretty close to the all-time high, which was set in 1991, and likely will be exceeded next year. But any way you measure it, as a proportion of revenues or outlays, or as a percent of GDP, interest will be exceeding its previous highs within the next few years. So the situation that we find ourselves in is a result of a structural imbalance between spending and revenues. That structural imbalance is caused by the aging of the population, rising healthcare costs, and mounting interest payments, which are paired with revenues that are insufficient to meet the promises that have been made. In the upcoming year, though, there are a number of policy debates which could affect its fiscal trajectory, perhaps for the worse. As Mark mentioned, there's the debt limit needs to be addressed sometime probably this summer. Appropriations for the current fiscal year 2025, still haven't been completed yet. And the big thing is that the expiration of a number of the individual income tax provisions that were legislated in 2017 are expiring at the end of the calendar year. And in particular, extending those expiring provisions could be very costly. CBO, the Congressional Budget Office and the Joint Committee on Taxation estimate that extending all of those expiring tax provisions would cost around $4.6 trillion, including interest, over the next 10 years. The House has put together a budget resolution, a plan that would allow for reductions in revenues of about that amount. They had $4.5 trillion over 10 years. And they would only partially offset that by reductions to certain areas of spending. And I think Carolyn is going to discuss that a little bit later. Congress and the administration are also looking to provide additional funding for border security, defense, energy production. And in fact, the Senate is going to consider their budget plan probably later today that would cover those areas, but potentially offset them. Our concern about the House budget resolution, though, and the Senate one as well, is that it includes very optimistic assumptions, which make it look like they're not making the deficit situation worse, but in reality, they likely would. For example, they have very optimistic assumptions about economic growth, maybe around 2.8% for the next decade, that are not supported by historical performance or, for that matter, by any independent economic forecasters. I mean, we have achieved 2.8% growth a few times over the past 25 years, but not for a sustained period. They also assume very large cuts in appropriations, so-called discretionary spending. They tally up about $1.8 trillion in such reductions, including a 15% cut next year, which has only been achieved twice in 45 years, and only right after very serious economic calamities, and 6.5% cut there in the following year after that. But to end on a more optimistic note, solutions are available. And I'll put in a shameless plug for a project we did last year called the Solutions Initiative, which gathered 7 independent think tanks to come up with their plans for addressing the fiscal situation. All of them managed to stabilize the debt over the next couple of decades. And in fact, a number of them would bring it below the level we're at currently. So it is possible to improve our fiscal situation, but it's not clear that we're on trajectory to do that at this moment.
Well, thank you, Jeff. And we are now going to turn back to Bill to introduce our next panelist, who will address what this all means for municipal markets in cities and states.
Yeah, thanks, Susan. Eric, you did a really interesting interactive study, which is linked on our site, on which states get hurt the worst by import tariffs, by new import tariffs, and which states would get hurt the worst by retaliatory tariffs from China, Mexico, and Canada. How is that forecast playing out, and whose oxes are being gored in this big fight?
Thank you, Bill. And thanks to the Penn IUR and the Volcker Alliance. Always an honor to be on screen with a group of speakers like this. So happy to be here. So as Bill mentioned, with Fitch Ratings, I manage the U.S. state governments team at Fitch. I will take a few minutes, and I'll touch on your question, Bill, to talk about our views on how tariffs, a really key aspect, obviously, of the Trump administration's economic policies, could have implications for different states. Then I'll talk a little bit about how tariffs are generally affecting Fitch's expectations for the U.S. economy overall, and of course, what this all means for our views on U.S. state government credit quality. So, as Bill mentioned, we did take a look at the Census Bureau's trade data just to get a sense of which states have the highest level of economic exposure with Canada, to trade with Canada, Mexico, and China. And we focus on those three countries because those are the countries where the president has already started the process of imposing blanket new tariffs, 25% for Canada, Mexico, and 10% for China. And just to get a sense of scale, we compare the dollar value of these countries' imports and exports in 2023 to and from individual states with those states' 2023 GDP. So Bill noted this, our analysis is linked to on the Penn IUR and Volcker Alliance websites for this webinar. So what we found is that Midwestern states' economies could be particularly vulnerable to imposition of blanket tariffs on imports from those three countries, and natural resource rich states could face the most direct consequences from retaliatory tariffs by those nations. So on the import side, Michigan and Illinois are the states actually with the most imports from Canada, Mexico, and China as a percentage of their state GDP. And interestingly, it's actually for two very different reasons. For Michigan, it's about the auto industry, which relies heavily on the movement of parts and finished vehicles across the US, Canada, and Mexico borders. And Michigan's home to just about a fifth of the US auto production. For Illinois, it's crude oil. Illinois is the fourth largest oil refining state in the country, and the biggest slice of its imports is crude oil from Canada. So now as tariffs get imposed, we expect other countries to retaliate with tariffs on our exports. And that's exactly what we've seen from China, which is already dealing with the 10% in additional tariffs that the president imposed at the start of the month. And that's part of the game plan that Canada and Mexico have already laid out if the 25% tariffs that are hanging over them do get imposed in early March. So in terms of exports, it's natural resource-rich states that are most exposed to retaliatory tariffs. North Dakota, Louisiana, and Texas are the states with the most in exports to Canada, Mexico, and China as a percentage of their state GDP. And when you recognize that the US is now the world's largest producer of oil and natural gas, that makes sense. So all of these three states are pretty key contributors to that. So that's a state level view of what the economic exposure to tariffs is. And I think it's too early to see and to say for sure exactly how that's playing out, but that's what the data suggests would happen. Let me zoom out a little bit and touch on how Fitch is thinking about what this means for the US economy as a whole. Our current house view is that US economic growth will slow this year in 2025 to 2.1%. That's versus the 2.8% the BEA just reported for last year. But some of the base case assumptions we built into that forecast, which we made back in December, could be too optimistic, specifically regarding tariffs. So the scope and range of tariffs that the president has for now put on hold for Canadian and Mexican goods are well above what we anticipated in our base case. We won't know for at least a few more weeks what actually happens here, but if the Canadian and Mexican tariffs get implemented as originally announced, then we see that putting clear upward pressure on consumer prices and firms' input costs. It also puts a drag on overall US economic growth. We think on balance, this would probably lead the Federal Reserve to further slow policy rate cuts. There's more detail on our analysis of how changes in US policy, including trade policy, are affecting our expectations of economic growth and credit quality, both here in the US and globally. And that's on a website that's also linked to on the Penn IUR and Volcker Alliance websites for the webinar. Let me just wrap up. I'm going to touch on what this all means for state credit quality and state ratings. Our outlook for US state and local governments this year is neutral, and we do expect that credit quality will be stable and strong. The vast majority of our state and local government ratings are on a stable outlook. Fitch sees governments managing a weaker but normalized revenue environment as economic growth cools. Governments enter the year with pretty strong financial resilience. For states, the median level of dedicated operating reserves is basically as high as it's ever been. So obviously, we still see some important risks. Number one is the potential for an unexpected recession, perhaps one brought on by material escalation in trade protectionism. And we're also keeping a close eye on other aspects of federal policy. Medicaid is the largest source of federal revenues to states, and we know that changes to this program are part of the discussions in Washington on how to pay for new tax cuts. So I'll leave it there and now turn it back to you, Bill.
Well, thanks, Eric. And we will get to Medicaid a little later on in the program in the Q&A. You know, it's funny, nobody thinks of Illinois as an oil state. But when I was a reporter covering the oil industry for various publications, the wife of the chairman of Standard Oil of Indiana, which was known as Amoco, was reputed to have said about the smell of oil, "I love it. I love it. That's money." So remember that it's big money for Illinois, whether you know that or not. And this is a reminder that you're tuned into Special Briefing from Penn IUR and the Volcker Alliance, and you can catch up on the archived editions of today's episode and all of our other special briefings on our websites and on the Special Briefing podcast. And thanks again to the Travelers Institute, the members of the Penn IUR advisor board, and the Volcker Alliance for your support of this program and our future programs. And now let's get back to the action and turn to Carolyn Bourdeaux, longtime friend of ours at Special Briefing and at the Volcker Alliance. She's down in Atlanta. Let's see how states and cities are faring with this deluge of executive orders and announcements and pronouncements. Carolyn?
Okay. Thank you, Bill. Thank you, Susan. It's good to be here. This is always an incredible panel, and I always learn a lot when I'm on these briefings. So I'm kind of at an interesting intersection here where I have worked a lot on state budgets. I worked a lot with the Volcker Alliance. I also spent a lot of time thinking about the federal budget. And when I was recently working on a project with the Volcker Alliance, we were asking states and people involved with state government what they saw as major future challenges. And I think almost every single state was anticipating some kind of challenge with federal retrenchment. So even though this is kind of coming in a shape and form that is perhaps different from what people expected, this definitely was on everybody's radar, that the federal government is going to have to retrench. And we heard Jeff with Peterson talk about the really serious challenges of the debt and the deficit and the potential impact, economic impact, if we continue on our current trajectory. What state and local governments really do need to think about right now, they're dealing with extraordinary uncertainty. There are two major places that everybody is looking at. One is what's the cuts coming down the pike, potentially with the reauthorization of the Tax Cut and Jobs Act. Jeff gave you some of those numbers, but that's they're looking for 1.2 to 2 trillion in cuts to only partially offset some of those the deficit impact of some of those tax cuts. And I'll get into some of the targeted areas. The other big ball that everybody needs to keep their eye on is what's happening with DOGE and with the Office of Management and Budget, which is going in and somewhat erratically, unfortunately, often illegally, but is just coming in, is shutting down programs, firing people, closing agencies. And that is introducing an extraordinary amount of uncertainty to state and local governments. Before I go on, though, I just want to caution, state and local governments really need to take this moment to do an assessment of how the federal government, federal spending, federal tax policy, even the economic impacts, how that will affect their budget. And they need to think of their budget not just in terms of those direct grants like Medicaid. They need to think of it as there are certain service portfolios. And just to give you a quick example, I've been talking to a lot of folks who are in the domestic violence shelters, in the mental health space. These are nonprofits. Often these programs are administered through vast webs of nonprofits. They are affected by Medicaid. They're affected by different block grants. They're affected in many different ways by what's happening at the federal level. And states need to think about, what's going to happen to service delivery, not just services they are providing, but services that are being provided through these networks. Okay, so backing up, what's happening with the Tax Cut and Jobs Act, the 1.2 to 2 trillion or so in spending cuts are, first of all, currently targeted towards Medicaid. Of that amount, 880 billion, and this is in the House budget resolution, in cuts has been assigned to energy and commerce. This is widely expected to be Medicaid. Another 330 billion is in education and workforce. So this is going to be Pell Grants, student loans, university type cuts. 230 billion in agriculture, and that is expected to be scale backs on SNAP. Now, whether they can deliver these cuts, who knows? You can see everybody cranking up and getting ready to fight back on this, but everybody needs to be aware these are some of the ideas out there. So you have, so Medicaid, what is on the table? There's a whole host of different cuts to Medicaid. One of them is to impose work requirements. And I can, see this being something that could be politically, potentially politically sustainable through the process. And I just want to give you a sense of what that is, because Georgia has imposed work requirements in its Medicaid expansion population. So Georgia did not expand Medicaid, but instead kind of did a modified expansion that required work requirements. What this meant was originally the expansion population was expected to be around 250 to 300,000 people. However, with the work requirements as a part of the expansion, I think yesterday the state announced that they have 6,500 people. So the work requirements are likely to substantially cut potentially the population that is able to get Medicaid. And also, one of the things they found in Georgia is it's very expensive to administer those work requirements. There's a lot of administrative overhead involved in that. Other cuts they're talking about, potentially eliminating provider taxes or restructuring those, capping the per capita payments, adjusting the federal matching rate. There's quite a long laundry list of cuts. Just things for people to think about, right? This is not just poor people not getting health care. It is going to affect industries. It is going to affect the economy. Something like 70% of people in nursing homes are on Medicaid. In Georgia, where we didn't expand Medicaid, we have struggled to keep rural hospitals open. So you can imagine that if we see big cuts in Medicaid, the impact on the economy of rural areas is likely to be substantial. And that has economic development consequences across big swaths of the country. What we find in Georgia is, if you don't have a hospital, it's really hard to attract a business to come there and to provide jobs. So that is something people need to think about if these cuts are going to happen. Similarly, you have 41% of the births in this country are covered by Medicaid. There are a lot of ripple effects throughout our economy and throughout our communities from these kinds of cuts. And people really need to think hard about what is fair and how to do this. I can talk about some of the other things if people are interested. You have SNAP, you've got Pell Grants. The other big piece that I'm hearing a lot from people in the state and local level about is the DOGE and OMB cuts. And you're, on the one hand, hearing from local governments and nonprofits who all of a sudden are finding their program has just been eliminated, arbitrarily just gone. You saw this with the Department of Education, where DOGE came in and just decided to whack a big swath of funding there. The other issue, though, right, is the extraordinary uncertainty that this introduces to everybody. Even though this may be litigated, and in several years, the courts may say, oh, wait, that was illegal. It's cold comfort to a nonprofit that is operating month to month, or a local government, right, that has a relatively fine margin that they're operating on. So I think there is quite a bit of danger in the DOGE and OMB situation. I am hearing that Congress and certainly the Democrats are likely to make a real stand around the budget. So we're operating under a continuing resolution that expires in the middle of March. And it is quite likely there might be a shutdown and a showdown that happens over these cuts in the coming month. So I'll stop there, and but I'm happy to take questions about details.
Well, thank you, Carolyn. It's notable that a lot of these cuts, tariff changes, are all affecting red states, and we'll discuss how that plays out. Let's see how things are playing out in the muni market right now. Had record issuance last year, but a lot of uncertainty now about federal funding, about rural hospitals. Hospitals are big borrowers in the municipal market. Vikram, what's your take on all this? How all this plays out?
Hi, Bill. Hi, Susan. Thanks for having me. It's my pleasure as always. And it is always very enlightening to listen to my panelists, and I enjoyed hearing their views. I will say, though, that I'm not as well. I'm a little more optimistic. Maybe it's because I was raised by optimists, and also because I'm not trying to address the questions for the ages, meaning the long-term impact of the fiscal deficit or the dollar. My views are a little more short-term. That said, I will say that with respect to President Trump and the current administration, I think it's important that we take their proposals or threats, whatever you call them, seriously, but not literally. And regarding tariffs, I know that, for a strategist, I feel as if my life has turned into a bit of a horror comedy, because there is so much coming out of Washington that it's very hard to respond to all of that. But a key point to note about tariffs is, and because we decide what risk to price and what not to price on a daily basis. So the tariff risk, I think most of our panelists understand this, is that, see, if it needs to be legislated for it to count as revenue offsets. So if the tariffs are implemented via executive action, then the CBO does not publish an estimate. The baseline remains unchanged. So the administrative changes have to go into effect, and then the CBO's next baseline update will include the estimated effect. So what I'm trying to say is that I think the majority of tariffs, at least they will be implemented via legislation, meaning the reconciliation bill, because they need the revenue offset to make to extend the TCJA tax cuts. Now, of course, there are other worries in the market, and all of us want the fairy tale, but there is this there's this famous paradox, right? That there was a donkey who was equidistant between a bale of hay and a pail of water, and he was equally hungry and thirsty, and he couldn't decide which way to go first, and died of hunger and thirst. And I bring this up because I feel as conflicted about risk. So I guess the joke is that I want the fairy tale, but I feel like a donkey. But see, the risk is concerned. There are some aspects that make me optimistic, or should I say bullish. And there I will bring into consideration the current administration, how savvy they are with respect to the market. Take into account Treasury Scott Besant's comments regarding the curve, the long end of the curve. So how many times has the Treasury Secretary come on and said that, look, we are looking at the long end of the curve because we know it matters to the market and to mortgage rates. So the Fed went and cut rates by 100 basis points, and rates went up by 100 basis points. But after the Treasury Secretary's comments, we rallied. And he understands that. So he talked about his focus. He talked about the fact that they'll keep auction sizes constant. They talked about Treasury buybacks to reduce the weighted average maturity of debt. And then, of course, there's deregulation that will favor Treasury holdings, meaning banks can buy more Treasury. So all this are bullish impacts on the curve. Now, there are bearish influences also. For munis specifically, of course, the pause to federal transfers and payments, that was taken into account when we published our issuance forecast for 2025. So I'm at 500 billion, which seemed high at that time. And it took into account that state and local governments will be getting less aid from the federal government. But things have moved very fast, and now I worry that I might be at the lower end of the range, and we could see even more issuance because state and local governments realize that they have to rely on their own sources to meet their projects and financing needs. So that's something to keep in mind where the muni market is concerned. I agreed wholeheartedly with what Eric said, that I'm not worried about credit quality overall, because the muni market, I mean, they have done a phenomenal job managing credit, managing their balance sheets, etc. But that said, anything like a potential reduced federal aid, it will force municipal entities to issue more debt, and the effects will be apparent very quickly. Now, there are wildcards, and aside from tariffs, the other wildcard that all of us worry about is the threat to tax exemption. Now, to be very clear, at present, there is no threat whatsoever to the tax exemption of outstanding bonds, and I firmly believe that if there is an attempt to curb the benefit of tax exemption, then it will not be retroactive; it will be proactive. So outstanding bonds will not be impacted, but the idea is to save the federal government money, and the Doge initiative. I agree that it seems haphazard and it's very controversial, but I think the objective is more noble, that they want to save the federal government, taxpayers' money, and in that sense, the mini market, their views, and the philosophy is copacetic with that initiative, because the mini market, the state and local governments, they spend their own money, they raise their own money to build hospitals, schools, bridges, and tunnels, so the federal government doesn't have to. So I want to believe that we will be protected, we'll be safe from these threats going forward. But again, there's a lot going on. So the next year will be very interesting.
So
back to you, Bill.
thank you very
Yes.
much, Vikram, and thanks to the entire panel. So I'm going to start with a positive proposition. Everyone has emphasized, and I certainly agree, that the main picture is one of uncertainty and also risks to the downside. But is there a potential risk to the upside? Is it possible that we will have more growth? And if so, where would it come from? And perhaps we could start with Mark, Zandi.
And panelists, Mark and panelists, would you please make sure that your cameras are turned on so we can see you.
So Susan, you're asking.
So what, and I would like Torsten to weigh in on this as well. We're right now, Torsten says Atlanta Fed says it's 2 point, what did you say, 2.2? I think the New York Fed has it closer to 2.8. But could we have an upside in growth in this year? And where would that come from?
Well, it'd have to come from either stronger productivity growth or more labor force growth. The economy's at full employment. So if you're going to get more growth, you need a stronger underlying potential growth. So it's possible. I mean, productivity growth has been strong. It's unclear why and whether that's largely due to temporary or longer term forces. So, could be the case for whatever reason. I don't think it's AI, but for, there's other potential explanations for why productivity growth could be stronger. I mean, we've had a lot of business formation since the pandemic. As businesses form, they tend to be innovative and generate productivity gains. So that's a possibility. And then on the labor force growth side, hard to construct a scenario where you're going to get more labor force growth because that goes to immigration. And of course, the administration is pursuing a very aggressive anti-immigration policy, but maybe that's more performative than it is actual, possibly. I don't know, I'm stretching, Susan. I
hear
I
that.
think
So
the risks are to the downside.
Mark, what is your projection for the year on GNP and more generally on inflation and interest rates? Where do you see interest rates end of December 2025? December 2025. What's your forecast? What is your forecast?
Well, let me say forecasting is a difficult profession. Forecasting interest rates is particularly intrepid, but if you're going to make me do it, okay.
I am. Here you go.
I think the best forecasts for long-term interest rates are that, they're going to be at the end of the year where they are today. I mean, the 10-year yield is 4.5%. If you told me it's 4.5% by the end of the year, I say that sounds about right to me. In the long run, abstracting from the vagaries of the business cycle, the 10-year yield should equal the nominal potential growth rate of the economy. The nominal potential growth rate of the economy is 4.25%, 4.5%. That's where 10-year yields. We're kind of sort of there already. I will say though, there's huge uncertainty around that given policy and what the Fed's going to do or not do. And I would also say the risks are decidedly to higher interest rates. In fact, let me just throw a stake into the ground. In my view, the biggest risk is that we see a major sell-off in the bond market. The bond market feels incredibly fragile to me. The plumbing is broken. The primary dealers aren't keeping up with the amount of debt outstanding. The owners of the Treasury debt are shifting away from the Fed and central banks, some commercial banks, to hedge funds, which are rapacious. They're very price sensitive. You've got the debt limit battle, dead ahead. There's just so many things that are coming together that I think there is a very significant threat that at some point over the next 12 months, we see a major sell-off in the bond market. Yeah.
So I imagine that's in part related to your inflation forecast. Is your inflation forecast that inflation will decrease coming slightly over the year, or do you see it? Sorry about that.
No, I think the disinflation is over. I had hoped we'd get back to the Fed target, but that was before the tariffs. I mean, President Trump is executing on broad-based tariffs. I think that's the most likely scenario. Again, a boatload of uncertainty. He can go in many directions, but that feels like the direction he's headed. That's already affecting inflation expectations and inflation. I mean, vehicle sales spurted because buyers thought, oh, I got to buy a car before the tariffs go into place. Dealers saw that and they jacked up price, by cutting incentives. So the effect of the tariffs on inflation are already being felt. And just take a look at inflation expectations in the bond market
3%.
or the consumer. So it's already happening. So no, we're not, the disinflation is over. And it's just a question of how much higher inflation goes. But it's now going to become a battle between growth and inflation, because growth is going to be weaker as well. So, but I don't see getting back to target anytime this year.
Torsten, you have a question out there that you posed to all of us and corporate leaders particularly. What's going to happen to long rates if inflation is sticky? So I'm going to turn your question back to you.
Yeah, no. Well, I just agree with everything as usual that Mark is saying. And I do think that this issue of if inflation is sticky, it just creates a lot of challenges for the Federal Reserve. Inflation at the moment is in round numbers 3. The Fed's target is that it should be 2. And as we're talking about here, the upside risks from tariffs, the upside risk from restrictions on immigration. If we also get lower corporate taxes for domestic manufacturers, Trump has talked about lowering corporate taxes for domestic manufacturers to 15%. That will also be putting some upside pressure. So let me just zoom out a minute here and just think about this in a global context of what really is going on globally. Is that we went from decades of globalization, and globalization means 3 things. That means free flowing of goods. That's disinflationary. Free flowing of labor, very broadly speaking, is also disinflationary, meaning keeps inflation and wages down. And we also had that policies and rules were very harmonized across countries, where you knew what the playing field looked like for your planning as a business. Today, including also the discussions in Europe, including Germany and elsewhere, we have almost reversed completely those three trends. The flow of goods with tariffs is obviously no longer as easy as it was before. The flow of labor, also, again, not as easy as it was before. And now we have industrial policies that individual countries, not only in the US, are picking sectors that they like for geopolitical reasons, for security reasons, for other reasons. And that all ultimately boils down to that we used to have a lot of forces that were pushing downward pressure on inflation. And now if you simply deglobalize in the way, not only in the US, in countries that we are seeing at the moment, where there's less flow of goods, that's inflationary, meaning that now that my suit and my shirt has to be produced in the US, that becomes more expensive. Now labor, and therefore wages, it has to be produced by someone who potentially will require and may need more pay because they simply have fewer workers available to do those jobs. And finally, industrial policies. It's a little bit mixed whether that's inflationary or not, but it's very clear that industrial policies are picking some winners and therefore someone who implicitly are some losers. And all this on its own is telling you that we went from a very disinflationary, low inflation environment to now a world going forward where we will have tailwinds that are now completely headwinds and therefore putting upward pressure on inflation. And that's the bottom line to what I think Mark and I agree on also here, is that is just creating a lot of challenges for the Federal Reserve when you already start out with inflation at 3. If inflation had been 1.5, it would have been a completely different discussion. But the problem is inflation is already too high. And that brings us to the conclusion that interest rates are probably going to stay higher for longer. And add
Really
on top of that the fiscal challenges, and we may also have higher for longer in the long end.
Let me ask a follow-up question.
Bill?
Yeah, and take this to the state and local level. Vikram, Carolyn, Jeff, especially. So inflation is maybe higher than we expect. That's going to have, at least in the short term, a positive impact on state and local sales tax revenue, even as their costs go up. On the other hand, we're hearing from Carolyn about a lot of dislocation in rural hospitals, big impacts from Medicaid cuts. Vikram says, well, states and localities to some extent are going to be able to borrow their way out of the hole. Are the revenues going to be there in states and localities to support this? Can states and localities borrow not really for operations, kind of the way Chicago is trying to do, but can not for operations, but to build the hospitals, to build the schools? Is the muni market, can the muni market really stop out some of this trouble? And it's a jump ball, whoever wants to take this wide question.
Hey, Bill, I can go first. So I wouldn't characterize my statement as, can the state and local governments borrow their way out of it? Though I agree completely that they're supposed to have a balanced budget, but we know that's not true. I mean, they do deficit finance, even though it's not called that. Now, I do worry about state and local government credit, especially the ones that are a little more pressured. There's no doubt about that. Now, also with respect to inflation, see, I don't know if I believe that higher inflation will be good for revenue collections right at the outset. But with respect to rates, and I'll stick my neck out a bit over here, I think rates will stay range bound because, again, the administration is watching the long-term rates very carefully. So I would say that look at the 10-year treasury rate at 4%, it's a sell. At 5%, it's a buy. And you will see that, we'll live and die by that, where the market is pricing rates, and it'll stay range bound. So I'm generally optimistic about growth. I do like the idea of pro-growth policies, and see, the U.S. has become a magnet for cash. I mean, you see the inflows coming in, and a very simple example that I quote very often is you look at NVIDIA, look at Apple, for instance. At one company, their market cap is more than the entire market cap of the FTSE 100. So that just tells you that American exceptionalism, it's not just AI. It's a story that I believe in. So I'm not that negative on rates. I do agree with my fellow panelists that I think inflation will remain sticky. I think the Fed cut a little too much too quickly, but so we probably won't see that 2% handle very, very, very easily. But that said, there are pros and cons going forward. So I think the picture over the next 12 months is very gray.
I'll just jump in terms of tax revenues. What we're seeing is that tax revenue growth is absolutely slowing and has been actually for at least a year or so now for state governments. That's got to put that in context, coming off of a huge and unbelievable pace of growth in the years coming right out of the pandemic. So it's slowing. It's getting back to kind of pre-pandemic normal levels. The wild card there for states is in terms of those that implemented major tax policy changes. In those states, we haven't seen what that actually means in a more normal economic environment. So there's a risk there that the revenue reductions coming from those tax policy changes are going to be more significant than anticipated. But slower revenue growth on the state and local government side is absolutely what we're seeing, what we anticipate going forward.
I would just to add something Eric mentioned earlier, that states are generally, still pretty strong. They have pretty substantial reserves, most of them, those that didn't give it all away. Georgia, for instance, has $16 billion in reserves, which is, I think, like 40% of its operating budget. Other states are not quite in that good a shape, but are still pretty strong. I think in terms of just not having reserves, right, you're looking more at the education. I think we're seeing more challenges. I do think rural governments, right, outside metro areas, they do stand to really be hit hard by a lot of the cuts that are being proposed coming out of the administration right now.
I got a follow-up question from a state leader, which is really a jump ball for everybody. It comes from Catherine Benham, who's the chief fiscal officer of the Vermont legislature. She asked, this is a toolkit kind of question. What are the key indicators you all are watching to evaluate the administration's actions and understand the impact? So when you get up, when you get up in the morning and you turn on your computer, you look at your Bloomberg or your whatever your info source is, what are the three things you want to see most every morning? Maybe Vikram, you're in the market. Why don't you start that? You're probably wired into the Bloomberg terminal.
I do. So I look at the equity market, and see that's important, because this whole notion that the equity market and rates, they're negatively correlated, we know that's not true anymore. And you think about the equity market as being driven by the Mag 7. And the Mag 7, they have so much money that whether the Fed cuts or not, it doesn't matter to them, because they are not borrowing for their financing needs. So that's one thing I look at. And obviously the long-term rates are important. So anything that the administration says, the Fed is obviously very important, but now the Treasury Secretary is also very important. So a simple thing like the Treasury's auction schedule. I was anxious about that, because in the past, Scott Bessent had talked about how he disagreed with Janet Yellen, the former Treasury Secretary's policy of issuing more bills versus longer-term debt, because the yield curve was inverted. And so I was worried that he will increase the weighted average maturity of the debt very quickly, which could have a bearish impact on rates. He didn't do that. So that shows a very pragmatic approach. Besides that, of course, the non-US developments are important, and I think energy is key. So energy, and my fellow economists will know that much better than I do, but see, anything that brings down the cost of energy and oil will be good for growth in general. So these, I would say that, headlines from the administration, the equity market, the long-term rates, and obviously energy rates are what I look at right away.
Mark and Torsten, what do you look at when you wake up and reach for your phone or your terminal?
Well, just to go first, yeah. So I think that at the moment, given this Doge effort, and given that the backdrop, as Mark and I agree on, is that the economy has been strong, and we came into 2025 at a high level of GDP growth, elevated inflation, it becomes pretty important whether Doge is going to lay off hundreds of thousands and potentially even up to 1 million workers or not. If it's a small amount and the unemployment claims is still very low, then I think we'll have smooth sailing. But if the unemployment rate begins to go up, it will begin to raise a lot of questions in markets about, is the economy slowing down? Should the Fed even be cutting again? Now we all agree that they will not be cutting. But if the unemployment rate goes up, that is page 1 in their textbook for what they should do with interest rates other than inflation. So rising unemployment, which we haven't seen, of course, now for quite some time, because we've been moving sideways for the last 6-9 months, would be a very, very important issue for markets in terms of is the slowdown here. And this comes on the back, of course, of the general discussion, namely, why didn't the economy slow down when the Fed raised rates? What happened to long and variable lags? Why did the economy continue to perform so well? So if the economy finally does begin to slow down in the form of an unemployment rate going up, that would be absolutely the number one thing that I think we should be paying attention to.
Yeah, I would, I wake up, first thing I look at is the 10-year Treasury yield. I think that is the single most important barometer of what's going on real time. And I look at it more than I should during the day. It's like my reels. My wife looks at reels. I look at the 10-year Treasury yield. Thank God she's not looking at TikTok. Thank God. But I look at the 10-year yield, and I'm totally with Thorsten. Those initial claims, I'd be on those like a laser beam. If that's a real, every week, Thursday, you get it from the BLS. got to be taken with a grain of salt. You know, there's all kinds of seasonal other issues, but you know, if that thing starts moving right now, what is it, Torsten? It's 220, something like that.
Yeah, that's where it came out. So it didn't go up this week, despite the firings from those. So we're not seeing that quite yet.
Yeah, so if it starts headed towards 250, I'd start sending off a little yellow flare. 275, we got a problem. 300, we're in the mess. But I'd watch that very carefully, because the thing that keeps the economy together is the consumer. The consumer will pack it in as soon as layoffs start to begin in a meaningful way. So I'd watch that very carefully.
I'll add one more thing that I look at that I think I should mention. News regarding the cryptocurrency is very important. So the legitimization of cryptocurrency, Bitcoin, of course, is included. See, anything that threatens the dollar's reserve status is bearish for rates. So I worry about that, because we know that the reserve managers, I mean, they buy the dollar, and how do they buy the dollar? They go and buy the 5-year note, and that keeps rates low. That's something that's a wild card. And, you know, I don't want to forecast where, you know, Bitcoin prices might go, but this was something that I was watching very carefully. The headlines regarding, and why should we give away that advantage? Because if you know, if reserve managers start buying crypto instead of the dollar, that's not good for rates.
Susan, we got time for maybe one jump ball.
Well, I would like to turn to Eric, Jeff, and Carolyn to finish us off and say, what is your major worry for the coming year? And maybe what is your major hope?
I can try and start. So my answer will link into what we were just talking about in terms of the things I'm looking for and the things I'm watching out for. So for me, the keys are the labor market, the consumer, and then specifically in my world, state tax revenue trends, which I think is a reflection of those three things. So I'm doing my best as a rating analyst not to look at the everyday changes that are happening, but look at a little bit more trends. But things like the labor market, the weekly unemployment report, the monthly non-farm payrolls, that kind of information, if those things start trending in the wrong direction, consumer spending, the monthly numbers we get from the Census Bureau, the consumer sentiment surveys that we get as well, if that starts trending in the wrong direction, we'll start to see that show up in state tax revenue trends. If they start falling well short of forecast, that's going to be the concern for us. That's going to what's going to raise a concern from credit quality from our perspective. So that's what we're going to focus on. I guess our hope would be that states are able to navigate through this uncertainty and continue to maintain the discipline that we've seen from a fiscal perspective and support credit quality, which is what we expect at this point, stable credit quality for state governments. So
state revenue, following revenue carefully, what would cause that to go down other than unemployment spiking?
I mean, it's the consumer and it's the labor market. That's what it comes down to in terms of us.
You're agreeing with Torsten and Mark. Jeff?
Yeah, I'd say our concern, we tend to take a somewhat longer term focus. Our concern is that legislative action this year will make our fiscal situation worse.
That's a worry.
You know, it's pretty clear there's a desire to extend the individual income tax and other policies that are expiring, and not much desire to offset them in realistic or meaningful ways. So my hope, though, is that that's not the case, and that there are enough legislators out there who would adopt a more fiscally responsible approach and try and balance off the desires for tax relief with, offsets that would not leave us in a worse fiscal position.
Keep the budget balanced. Okay, Carolyn, we have 30 seconds. Finish this off.
Okay, so the real concern I have is with what DOGE and OMB are doing is undermining the faith in the rule of law. And this will introduce uncertainty into whether the United States will honor its contracts. And that includes contracts with bondholders, right? But it also undermines the faith in our institutions as they make these cuts. So
Carolyn, I'm going to push back because is there any hope?
Well, I just want to make this point because it's really important. Will people stop flying if they feel like the FAA is not fully staffed, right? And this has economic implications that people are not thinking about. I hope that Congress steps in and really weighs in and tries to reestablish regular order around how we're approaching this.
Thank you so much, Carolyn. Thank you to the entire panel. Bill, take us off.
Thank you. And folks in the control room, thanks for putting up the information slide. Here's our panelists if you want to follow up with them. And that is it for a very busy edition of Special Briefing. Thanks so much to our fabulous panelists. Thanks also to our co-host, Susan Wachter, and to our production team, Megan Schmigdal, Amy Montgomery, Graham Dowd, and Noah and Ritzenberg. And Special Briefings are made possible by funding from the Travelers Institute, the Volcker Alliance, and members of the Penn IUR Advisory Board. Thank you to you all. I'll be back with Penn IUR co-director Jeannie Birch, Susan's partner, at noon Eastern Time on Thursday, March 20th, to ponder the future of mass transportation under President Trump and the Republican Congress. We just had that announcement yesterday that Trump wants to halt congestion pricing in New York. We'll see. So please watch our websites and your email for details, and look in the chat box on your Zoom screen for a link to sign up for further info. And remember to catch up on this and all of our other special briefings on our podcast. And so for now, I'm Bill Glasgall on behalf of Susan and our team, and we'll see you again on March 20th.